Dipan, there is merit perhaps in not just HPCL, BPCL. Some would say that one thing is evident, that the US administration will do whatever it takes to keep crude down, because it is perhaps important for them to keep crude down to manage their expenses. If crude is directionally lower, if wars are getting, ceasefire rather than wars now, is it time to buy crude derivatives? It may not be HPCL, BPCL, I still think they're regulated, but let's say Pidilite, Asian Paints, it easily may be anything and everything which has got to do with transportation.
See, Nikunj, if you want to play the investment theme of lower crude oil prices, the best way is to buy the oil marketing companies. And I think that they are getting a lot of investor interest and a lot of expansion plans going on stream for all the oil marketing companies. The investments which they have made, I think a lot of them are reaching commissioning stage. And lastly, I think that valuations are really attractive over there, and it's a neglected sector. So you always have this, kind of thought process that neglected sectors may do well in the next phase of a bull market. So from that point of view, also HPBP, IOC, there's scope for earnings to improve because of lower marketing losses, and also the fact that P multiples can get rated upwards as there is more certainty around their profitability. So I would say that from an investor's perspective, if you want to actually even lower the overall PE of your portfolio, these stocks are good to invest for the next 6-12 months, maybe a year or so. And then let's wait and see how oil prices actually, perform over the next few quarters or so.
We've been discussing metal stocks, and the logic here could be China is getting better, Europe is stimulating its economy. You do have a sense that things are looking up in terms of where the European dominated businesses are done. But one company which I think could really be attractive, and Dipan, I'll take my chances with this one, is Tata Motors. The dependence on JLR, everyone thought that is going to be a curse, then it became a boon, now it's become a problem. But at current level, if somebody is buying Tata Motors, are you buying a good company at a decent price?
See, it's a difficult question to answer because right now Tata Motors could be a value trap as well. No doubt its valuations are very attractive, but the way the uncertainty is there around JLR, I would just like to avoid Tata Motors. Our bias is more towards other auto companies, maybe Maruti, M&M, Eicher Motors, and there's only so much exposure you can take to automobile companies. And there are a whole host of auto ancillaries also which have corrected, pretty nicely. And they're also pretty interesting because most of them are not impacted by the shift from ICE to EV. So I would say that given so many choices, I would go with other auto ancillary companies rather than Tata Motors. But look, Tata Motors does have a way of surprising investors on the upside and the downside. So one can't really say. But all I can say is that fundamentally, it's a very difficult company to track and had a handle on.
Within pharma, could it be Dr. Reddy, could it be Cipla, could it be some of the domestic companies? Very difficult to fathom. But for the moment, it clearly appears that from a tariff standpoint, whatever adjustment we saw in some of the pharma companies, that now seems to be, adjusting. I think it's quite evident. Dipan, more and more reconciliation in the market seems to be coming that if tariff on pharma is imposed, it's going to hurt the US economy more than it will affect Indian pharma companies. While it may help the US trade deficit, it could increase healthcare costs, which is actually a bigger burden. So should one buy into this entire pharma suspense or tariff suspense pharma stories?
No, Nikunj, I don't think so. And the reason for that is that if there are levies on import of pharmaceutical formulations, it's certainly going to affect the profitability of these companies. It's easy for the management to assume that they'll get passed on, but it doesn't really work like that. And I would just be a bit cautious when it comes to pharma. Also, we are seeing mild slowdown in the domestic market sales also, so that's also a bit of a concern. And base effect also is coming into play for a whole host of pharma companies. So I'd be a bit cautious. But once we have clarity on Trump tariffs and once we know for sure that what exactly is the import duty he wants to put on pharmaceuticals, then there could be interesting bets over there. But within the pharma space also, if you want to be overweight, I would go for the CDMO players. I think they are to an extent more protected than pure generic players. Companies like, say, Divi's Laboratories, Suven Life Sciences, Piramal is there, and there is this One Source, the new listing, which has been, from split out from Strides. There's Blue Jet, I think if I got the name correct. So these are companies which I would say I would focus on and increase our coverage over there. Because these businesses, I think, have great potential considering all the various industry dynamics taking place over here.
If you like this video, then like, share and subscribe to ET Now.